At 9:31 a.m., the markets look calm. A utility company quietly locks in next year's borrowing costs. A shipping firm hedges fuel prices. A pension fund nudges its exposure to rates down a notch. Nothing flashy, no headlines, just a million tiny contracts that make the world's cash flows feel predictable. By lunch, the news cycle is still boring, and that's exactly when the most dangerous part of finance does its best work. In silence. Because under that calm sits a number so large it feels like fiction, roughly $600 trillion in derivatives, not 600 trillion in cash-changing hands, but in promises. Lines in legal documents that behave like dynamite when someone steps in the wrong place. What is a derivative, really? Forget the jargon. It's a contract about something else. If interest rates go here, then you pay me that. If the dollar rises there, then I pay you this. If oil breaks that price, we settle the difference. Futures, options, swaps, they're all versions of if-then written in money. Used well, they're seatbelts. They smooth out risk so businesses can plan. Airlines hedge fuel, exporters hedge currencies, builders hedge interest rates. Used badly, they're accelerators. They let you borrow the future to amplify the present. Here's the trick that makes the numbers so big. Derivatives quote a notional amount, the imaginary pile of money the contract references, so a $100 million swap might only require a small sliver of actual collateral to open that notional stacks into the $600 trillion figure. The true economic exposure is far smaller because positions offset and netting agreements cancel lots of you owe me, I owe you loops, but far smaller can still be deadly when markets jump. Because you don't settle the entire notional, you settle the part that moves, and when it moves fast, your collateral has to move faster. Let's walk the map. In the middle stand the dealers, big banks and broker-dealers that make markets in swaps, options, and forwards. On one side, real economy hedgers, corporates, insurers, pension funds, trying to dull risk. On the other, funds and fast money, sometimes providing liquidity, sometimes harvesting it. After 2008, reform shoved much of this traffic through central clearinghouses, CCPs, that sit between buyers and sellers that reduce the risk that one default dominoes directly into another, but it also concentrated pressure in a few hubs. When volatility spikes, CCPs don't debate. They call for margin now, across everyone, at once. You've seen versions of the margin spiral. In 2008, AIG wrote insurance on mortgage bonds, credit default swaps, without keeping enough cash to meet collateral calls when those bonds fell. It wasn't the notional that killed AIG, it was the sudden demand for cash when prices gapped. In 2021, Archegos used total return swaps to borrow exposure to a handful of stocks. The positions lived off balance sheet at prime brokers, until they didn't. One bad week and the synthetic leverage turned into real sales at real prices. In 2022, UK pension funds used a sober-sounding hedge called LDI, liability-driven investing, to match their long-term obligations with interest rate derivatives. When gilt yields jumped, the hedge needed more collateral than the funds kept handy. To raise it, they sold gilts, pushing yields higher, triggering more margin calls. That's a loop. That's the line you don't want to cross. So where's the line? It's not one number, it's three crossing points. First, concentration. If too many players crowd the same bet, rates will stay low, spreads will stay tight, currencies will stay pegged. Then a small move forces the same behavior everywhere. Everyone de-risks, then everyone sells, then everyone wonders why prices are falling faster. The tail wags the dog because the hedges start moving the market they were meant to tame. Second, correlation. Hedging assumes some risks offset. But in a stress, things that were separate start moving together. Stocks fall, credit widens, the currency swings, and rates jump. All at once, correlation goes to 1, and trades that relied on diversification become just another long position wearing a different hat. Third, collateral. Derivatives live on the oxygen of margin. When prices shift, collateral calls arrive by rule, not emotion. If your liquidity is tomorrow, you are already late. That's why derivatives risk is often a timing risk. You may be solvent on paper and still fail because you can't meet a call by 2 p.m. There's also a hidden species in this ecosystem, FX swaps and forwards. Global companies and banks constantly exchange dollars for euros, yen, and sterling for a few days, weeks, or months, then swap back. The notional is huge, the maturities are short, and the funding is critical. When trust wobbles, the price of these swaps, basis, blows out. If you need dollars and your usual pipe clogs, you don't miss a growth plan. You miss payroll. None of this means derivatives are evil. In many ways, they're the plumbing that keeps the real economy from freezing every time prices jiggle. A farmer locks in a crop price. A hospital fixes its borrowing cost. A home builder caps the rate on a construction loan. The world works better with these tools than without them. The danger comes when the tool uses you, when a hedge becomes a profit center, when an insurance sale turns into an addiction, when you count paper gains as permanent and treat collateral as optional. Let's make it concrete. Imagine a real estate investment trust that built a portfolio when money was cheap. To protect against rising rates, it paid a bank to receive a fixed rate and pay a floating rate. A standard interest rate swap. Good idea. Rates rise, the swap makes money. On paper, they're safer, but the swap is in the money. The CCP asks for variation margin daily. That's cash out the door now, even if the REIT will earn it back slowly through lower interest expense later. If the REIT didn't plan for daily cash movement, it starts selling assets to post-collateral prices fall, lenders get nervous, and a sensible hedge becomes a stress amplifier. Same math for a corporate treasurer who hedged currency exposure, or a fund that wrote options to boost yield. What protected the income statement can still threaten the cash account. Where's the regulator in all this? After 2008, the system got sturdier. More clearing, better reporting, higher capital at dealers, more standardized contracts. That's real progress. But risk migrates. When banks tighten, private credit grows. When CCPs raise margins, some trading moves bilateral. When disclosures improve, complexity shifts form into basis trades, structured notes, and bespoke hedges that live in footnotes few people read. The goal isn't to fear complexity, it's to refuse complacency. Complexity punishes lazy balance sheets and rewards those who ask annoying what-if questions while the room is still quiet. There's a human rhythm to these crises. In the good times, derivatives feel like free income. You harvest a little premium here, write a little optionality there, lean into carry, and tell yourself it's just steady yield. Then one day, the emails hit inboxes, increase margin, additional collateral required, close out provisions. Desks that joked about basis points now argue about basis risk. And suddenly the biggest number in finance, 600 trillion of notional, stops being abstract and starts dictating behavior in boardrooms, city councils, and kitchen tables. So what do you do if you're not a derivatives trader? 3 things translate to every balance sheet. 1. Respect liquidity. If you own anything that can move fast against you, keep cash that can move faster. 2. Shorten your promises. Match the term of what you own with the term of how you fund it. Don't finance a 10-year hope with a 10-day loan. 3. Watch the crowd. If everyone is making the same risk-free trade, it is not risk-free. It is crowded, and crowded trades don't unwind. They stampede. Back to the quiet morning. The utilities hedge works, the shippers hedge works, the pension funds hedge works, because they treated derivatives like brakes, not boosters, and because they staged their collateral where they could reach it without selling the thing they were trying to protect. Across town, a fund that sold options for yield learns a familiar lesson. When you underwrite calm, you owe cash in storms. The derivatives line no one wants to cross isn't a number on a screen. It's the moment when promises outrun the cash behind them. Derivatives let us share risk and price time. They also remind us that leverage hides best in good intentions and tidy spreadsheets. If you understand that, you don't have to fear the $600 trillion. You have to respect it by staying liquid, staying matched, and never forgetting that in a world of if-then contracts, then can arrive all at once. Finance loves grand theories, but the story that keeps repeating is simpler. When volatility rises, collateral calls. When collateral calls, behavior changes. And when behavior changes everywhere at once, prices move in ways models forget to allow. The solution isn't to swear off the tools, it's to use them like a pilot uses instruments, to stay level when the horizon disappears, never to chase altitude you didn't earn.